The market is continuing to go up, but it's still making everyone feel uneasy because we know it doesn't make much sense. It seems like a lot of Federal Reserve manipulation, but we don't know for sure. Maybe everything is all good. So of course the question that we all have is what that bottom really was. Was it real? Or are we all getting sucked into the market right now before another huge crash that's about to happen? So in this video, we're going to look at the data and see what's going on. And also at the end of the video, I pulled up some really solid advice from Lee Lu. And Lee Lu is basically Warren Buffett's and Charlie Munger's protege. He currently runs Himalaya Capital, which is a value investment fund. And he's one of the front runners to take over Berkshire when Warren Buffett and Charlie are gone. So definitely stay tuned for that because he has a really good way at looking at markets like this. And before we get started, make sure you download the Explosive Stocks checklist. There's a link down below in the description and comments. Free checklist that basically shows you our strategy for picking stocks that do well in this type of environment. Check that out. It's free. Link down below in the description and comments. So we're going to go over the latest Monday Dirty Dozen from Macro Ops to figure out what's happening in the market. And this quote from Charles Faulkner in the beginning is pretty good. People need to have a perceptual filter that matches the way they think. The appropriate perceptual filter for a trader has more to do with how well it fits a trader's mental strategy, his mode of thinking and decision making, rather than how well it accounts for market activity. When a person gets to know any perceptual filter deeply, it helps develop his or her intuition. There's no substitute for experience. And Charles Faulkner is a top trading coach. So he's like Wendy from Billions. He was even profiled in Market Wizards. So the way I interpret what he's saying is that your strategy really needs to fit with your personality. There's no one way to view the market, and everybody, all the professional guys are wrong a lot. But you only need to be right a few times. And everyone is wrong or right at different times as well. So one person can be completely right on this time frame, and then another person can do the opposite on a different time frame and also be right. So really the important thing is fitting your strategy with your perception and your personality so that you can be good at what you do and executing your strategy versus a strict objective approach to the market that everyone has to follow, because there isn't one. So at the end of the day, like I always say, stick to your strategy. Now let's jump into these charts. Check out the broad global money supply right now. It is exploding higher. And this has a huge impact on markets, especially stocks, because we've talked about this before, but the stock market is just supply and demand. That's the basics that it comes down to. So if there's a lot of demand chasing after a little bit of supply, the price of that product is going to shoot up. So we can use that lens to look at the stock market too. On the demand side in the stock market, we have the amount of savings available to invest in, which is driven by the credit cycle. And we basically have the allocation of people's portfolios. But this right here, with so much money in the system, that's all demand. Like we've always explained, more liquidity means more money going into assets. But then we got to look at supply. And supply in the stock market is just not the total amount of shares. It's actually the aggregate market value. So it's basically like the market cap. And market cap, you know, is the number of shares in the market times their price. So that means supply in the market is actually flexible. Yes, there's a fixed amount of shares, but the market cap, you know, it keeps rising. Because if you have all this demand, all this money chasing after these stocks, like I said before, yeah, their prices are going to rise and the market cap is going to become larger and larger. But eventually, you know, it's going to become too large, and then that's when you see prices falling again because the demand can't keep up with the supply. So the question here is, how much can the global governments keep on printing, and how much will demand increase? Because at the same time as demand is increasing and prices are getting pushed up, supply is increasing at that same time because market cap increases. So will that demand offset the increase in the supply? If it does, then prices are going to keep going up. But if supply becomes bigger than demand, then we're going to see things turn around again. Another fascinating thing about this market is that it continues to go up even as earnings of all the companies that make it up just crash through the floor. This chart from UBS right here shows the earnings expectations across different indices. You can see how huge this drop is. That's why you should never complain about the stock market not matching up with the fundamentals, because over the short term, clearly fundamentals don't even matter. You saw from these earnings expectations that these companies are collapsing. A lot of them aren't even giving guidance, but still the market keeps going up. It's just completely detached. That's why there's that famous Druckenmiller quote. It's not earnings that move the market, it's the Federal Reserve. It's how much money they're pumping into the system. That's what's going to determine it. So you should never get stuck in that mode of thinking that, hey, this can't be possible because this company only makes this amount of widgets and the economy is doing this. It doesn't make any sense. That might be true over the long term, but you need to look at the shorter term too so you don't get screwed over. Like even if this current market doesn't make sense, you could still make money on it. But either way, it's important not to just get stuck on fundamentals. There's more to it than that. So another interesting thing from that same report is that earnings per share tends to follow the same bottoming pattern after these three things. So consumer expectations, USA growth expectations, and then the Bloomberg Economic Surprise Index. So you can see right here, these are all screenshots from the 2000 tech bubble. You had consumer expectations bottom first and then go higher. EPS bottomed a little while later. And you saw the same thing with the expectations of economic growth and the economic surprise index. So if we look at those indicators right now, you can see that only one of the three have bottomed. So expectations of economic growth in the US, this red line is going back up. But the blue line, which is the Bloomberg Economic Surprise Index, still heading lower. And consumer expectations, which is the green line, still heading lower. So we might not see earnings per share recovery yet. Still got to wait on these things to bottom. So our current target right now for where this bear market rally will go is the 3,000 to 3,100 level right here. And you can see this is where the 200-day moving average of the S&P is as well. That's this blue line. So Alex says that he thinks that we'll get there within the next 2 weeks, meaning we still got some room to go in this little bear rally. The AAII net bull bears hit new lows last week, meaning that sentiment in this market is still very bearish. And even with this huge rally that we've just had, sentiment hasn't turned around. And you can see that sentiment right here, this red line, is at 2 standard deviation lows. And if you look back, it's highlighted in green. Each time it hit this level, the market just kept going higher. So even after this rally, if we're still at these lows, then there's a good chance we can still go higher. And sentiment is a contraindicator. So if people are really bearish, that's a good sign, because that means there's still more money that can come in. So that's why when we're looking at this graph right now, that's how we interpret it. Oh, bearishness is good for the market because it'll go higher. When people are too bullish, that means all their money is in the market, and that's when you could expect the market to turn around, because there's no more buyers on the sidelines. All the people are in the market, and at that point, what can they do other than sell? So with sentiment still so negative, yeah, there's a good chance that we keep going higher from here. Now, if you look at this chart right here, which marks in yellow every time the market has hit 2 standard deviations oversold over the last 25 years, that has happened 18 times. And it just happened with the big crash that we just faced. Well, only 5 out of 18 times has the market recovered to new highs over the following year. But the other 12 times after something like this happened, we saw follow-on losses averaging 19%. Meaning that even if we get this rally that keeps going, it's very unlikely that we're going to make new highs. Low probability. We're still going to see things turn around. And one thing that's great to look at as an indicator of where markets will go is the credit market. You can see that right here. And Alex says here, in the hierarchy of markets, credit sits near the top, just below industrial metals. So if you're holding stocks, you want to see what the credit market is doing. So when this crash happened, you can see this red line here, it spiked like crazy. That's the US high yield credit spread. Now, if you zoom in right here, you see that it did recover somewhat, but it's begun to turn up again. So when this spread widens, that's a bad sign for stocks, because it's a bad sign for risk assets in general. Like it says here, credit markets will determine if this is a bear market retrace or a bull move off of the bottom. So this could be a blip, or this could be the start of another move higher in this credit market spread. If it does move higher, then that means that this whole rally that we've seen is in fact a bear market rally, and that the bear market isn't over. So we'll see a secondary bottom. And that's really still our base case of what's happening in this market. We still think that this whole rally right now is a bear market rally, and that we're still going to see the double bottom. This is still within the normal range of what happens in bear markets. And it's why any unease about how the market has been going up may be, correct. So the way I'm playing it is trying to take as many profits as I can. If this turns out to be the start of a new bull and it's not going to go lower, then great. I might have a smaller position because I've taken so many profits, but I'm fine with that. It's okay to be conservative. There's nothing wrong with taking profits. But most likely, from our research, we will see the second low. And with all the froth of all these new investors jumping in, at least from what I've seen, it would be just like the market to make them all feel that pain, which sucks, but that's how it goes. Sucks everyone in, and then just as everyone's in, the market turns around and screws as many people as possible at one time. So it's definitely good to be cautious. And speaking of cautious, the gold miners ETF closed at 7-year highs last week, and Alex said that it did so on very little fanfare. So what he's thinking is that the gold bulls have been beaten up way too much from the numerous false starts over the years. So the sentiment is still negative around gold because they just don't believe the move. But because they don't believe it, and we covered gold in a previous video, it's likely that this is actually the real move. Again, everything is opposites in the market. If everyone hates something, it's usually good. If everyone really likes something, it's usually bad. That's how you read sentiment. So gold might be ready to take off. Now, as I said, we were going to get some advice from the very smart Li Lu, who is this guy right here. He's Buffett and Munger's protege, really sharp value investor. He's probably going to take over at Berkshire eventually. So there's an old interview that he did from 1998. So in that time, it was the tech bubble. So that's what he was discussing. But it's very good advice. He said the market is not a man's sex drive. If you had to compare it, this market is a woman's sex drive. Wow, women in markets, nice. That's something we don't see enough of. It's really experiencing a multiple climax, but even the woman has downtime. Wow, Li Lu, it's incredible. It's like Animal Planet the way you speak of the woman. The traditional Chinese sentiment is that the woman has the capacity to climax 15 times. Oh. All right, where does this sentiment come from? Do they teach this in schools? Is this like only in China or something? Because I have never heard of this. Normally what I hear is, AK, I'm just looking for one good one. Please, just once in a while, AK, just do better. I've never even heard anyone think of the number 15 in this situation. Ridiculous. The market is turning into the traditional description of the woman's sex drive. My girlfriend is around that number. Oh, wow. Little shout out to the girlfriend. You know, any girlfriend would absolutely love this type of shout out. And also, what a casual, humble brag. Basically what Lilu is trying to say is that not only is he good at deep diving into value plays, but he's also effective at deep diving in other areas. The patience he's developed in value investing to control himself and not just blow his money load before the deal becomes just right, it's really served him well. I wonder if he wears one of those Trojan margin of safeties. Nah, I bet he just raw dogs it because investing has taught him the perfect time to pull out of something. Lilu, you dirty dog with that dirty smile. Did you learn this from Grandpa Warren? Is that what happened? That's the real protege relationship right there. It's not about value investing. It's just about being a player. Just like Buffett had his wife and his girlfriend. Looks like to be a good value investor, you gotta be a dog. And to be an effective dog, you need to understand the woman. And the woman is able to climax 15 times. And really, that's the main advice that you should take from this video. And as you can see, it's very useful in evaluating the market right now. So get out there and try much harder. And before you go, make sure you download the Explosive Stocks Checklist. It won't help you with the woman, but it will help you with the market. It's a free checklist. There's a link down below in the description and comments to get it. And if you like this video, make sure you subscribe so you can get the best advice in the world from the world's best investors. They have so much knowledge that the rest of us don't have. Subscribe, and I will see you in the next video. Stay fallible out there. Bye.